Well, we'll get started. Thank you. Good morning, everybody, and welcome to Village Wealth's webinar series on buying a business. And this is very thankfully sponsored by Fasken. So we'll get into some details on that in just a moment. And we'd like to welcome Felicia Marr from BDO. And again, we'll get into her introduction momentarily. So this morning we are talking about tax implications when buying a business. And so how a deal is structured will have an impact on tax implications post-acquisition. And understanding tax considerations before you buy a business can be great knowledge when negotiating a deal that you can take across the line. As a buyer, understanding both your own and the seller's perspective of how their tax strategy will play out will play a big part in the acquisition process. And so we'll get into these details in just a moment after a little bit of an intro. So thumbs up if my slides are advancing, because we're having a bit of a, Zoom technical challenges as we do. Looking good? Great. Thanks, Liz. All right, so I'll introduce myself. Normally we have Liz McRae here today, the co-founder of Village Wealth. She's unwell today, so she's in the background on the chat. She'll be providing her insights and monitoring the chat and other pieces of the Zoom webinar from there. I am new to the Village Wealth team, though I've worked on and off with Liz and the team throughout maybe the past decade. My name is Bridget Legault. I've come on board as the community manager, and we'll share a bit more of what that means here in just a moment. I myself have bought and sold one business, a small business, many moons ago. I'm currently also an entrepreneur and a management consultant. And so we'll talk about this community that we're building here in just a second. We want to make a very special acknowledgement to Fasken, one of the most active M&A teams in the country, and who are sponsoring this webinar series for us this year. So a huge thank you to Fasken for your support. And so who is Village Wealth? If you're unfamiliar, if you're new to them, we are a tech platform based out of Calgary, Alberta. And we are here to solve the problem around nearly 70% of new buyers' businesses deals falling through. So deal structuring and financing are two of the biggest barriers when it comes to new buyers and business acquisitions. And we are really on a mission to solve this. And before I get going too further here, maybe I'll just get folks to share in the chat. And thanks for muting everybody. We'll get you to share in the chat, where are you joining us from today, so we can get a bit of sense of where everybody is. I'm just west of Calgary in the Bragg Creek area, so just to give some context there. And most of the team is here in Calgary. And so Village Wealth is an acquisition management platform, so kind of a wholesome solution to the business buying process. A lot of our products and services are focused around finance being at the core of that. Our community and guidance aspect of the business really helps buyers through the complexities of this process. And then we have our marketplace, which is really unique in this broader ecosystem, in that we are a marketplace for buyers. We feature buyers, vetted buyers, where sellers can then find vetted buyers and target them. So a bit of a flip on the traditional seller marketplace. When we're talking about the business buying process, we look at it in these stages. And so we won't go into great detail here, but just to give some context of how Village Wealth supports this process. When looking to buy a business, many just start with looking at marketplaces, though there is this very nuanced and unique process that you'll go through as a business buyer, and it can get very complex, as I've mentioned. And so in building a strategy and defining those goals and your search criteria is really key to finding the targets that make sense for you. In the search process, we look at how to search and target businesses, both ones who are publicly listed and those who are not. We talk about the evaluation aspect of this, where we start to analyze fit and test our affordability, possibly deciding to make an offer and moving into that letter of intent phase, where we're really looking at how the offer is being structured and how we're going to negotiate it. And finally, not quite finally, but the financing and due diligence stage, which is where one of our new products, Acquire Well, sits. We'll talk about it in just a moment, where we're looking at deal structure, we're looking at talking to lenders. Hopefully those relationships have been built, and working through the legal and financial due diligence of the deal, and finally through to that celebratory moment that can take some time of closing, finalizing that financing, and taking over the business. And so we'll talk about those tax implications today and how they play into these, particularly these latter phases of the process. And so from a Village Wealth perspective, these are some of the products that we offer to support through these phases. We have our Buyer Lite subscription, which is access to the buyer profiles, the marketplace. And so you can go on villagewealth.com right now and fill out your buyer profile. And there is quite a bit of search criteria there. So we're happy to help walk you through that if that is overwhelming. You can message directly with sellers privately in that marketplace as well. And we have our new digital community, which you will actually be the first to access today. We'll talk about that in a quick sec. We also have our Prep Plan program, which really helps guide you through those stages we talked about, through coaching, guidance, tools, templates, private events where you have access to advisors. So a lot of value in that program if you're looking to really get into the nuances of the buying process. And finally, Acquire Well. So if you head on to the website right now and look at this product, which we have a new version of, which we're really proud to share with you today. This is really a finance concierge service. So we really do the heavy lifting for you around lender management and creating that deal structure, walking you through the letter of intent. So a little sneak peek at what that Acquire Well software looks like, and another sneak peek into some features to come, which is a dashboard where you can host all of your deals, get your lending readiness score, take a look at different structuring opportunities, and get that really hands-on guidance through the deal process. And so lastly, I'll sit on this slide for a moment so you can scan the QR code. We are launching a digital community today. As I mentioned, you are the very first to be welcomed into that community. So we are building out features, tools, and resources as we grow this community. As you enter it today, you'll be taken to a platform powered by Mighty Networks. You can create an account there, fill out a profile, and start sharing your questions, your curiosity, share knowledge with other business buyers, maybe even share deal flow. You have the opportunity to post questions publicly or to direct message others who are located near you or across the country, across North America, frankly. And there will be access to exclusive events and tools and all sorts of good stuff in there. But the real magic of this platform is that you will have access to other buyers who are kind of walking this path with you. And as I mentioned, such a nuanced journey that often just having the ability to ask people questions who are living this journey too is some of the best way to accelerate both your confidence and the process for you entirely. And so with that, we'll get into what we came here for. We'll get into our guest speaker here momentarily. I've already asked you to share where you're from, so if you're just jumping on now, please do feel free to share where you're calling in from today. If you're able to identify where you are at in the buying process, that would also be great. If you're searching for a target, or maybe you're already at a letter of intent, that might help guide the conversation as well. And we will have Felicia from BDO share with us for roughly 30 to 40 minutes, and then we'll go into a Q&A portion where you can then share your questions and your curiosities. So Felicia, I'm going to turn it over to you to introduce yourself, and we'll get right into the conversation.
Hello, good morning, everyone. So, just so you know, from time to time, I will need to look up because I want to see the people on screen. So, it may look like I'm looking at something, but in fact, I'm actually looking at you. I'm watching you. Um, so, this morning, my kids told me to break a leg, right? So not they didn't say break a leg. They say break everybody's leg. And without knowing, they probably did not know I was not going to be presenting in person, but they asked me to break everybody's leg. So I don't know. That sounds to me criminal. Um, so my name is Felicia Marr. First of all, thank you, Villager Wells, for having me. I bring nearly 2 decades of expertise in Canadian corporate taxation, and with the last 10 years or so dedicated to tax planning. I am also a tax educator with CPA Canada for over 10 years. I have instructed in the 3-year in-depth tax program designed for designated accountants and lawyers who want to become tax specialists, as well as a corporate reorg course for experienced tax practitioners practicing tax more than 10 years. So every year I would spend probably 2 to 3 weeks of time involving in those courses. As a tax advisor, in my experience, I have guided individuals and entities through their buy and sell deals. So every phase that Bridget mentioned, we actually generally involved in the very beginning of the process, because when you kind of start setting the strategies and goals, you one big component that you need to think about is your tax strategy. Okay. Therefore, we generally get involved in very beginning, or if, for example, they are not our clients, other advisors will kind of reach out to us already as to what to plan ahead. I am quite thrilled to be here and share this knowledge with you, hoping to bring you awareness of some key considerations that you apply as you begin your acquisition journey. And you, as a buyer, will inevitably increase your bargaining power and be well positioned when you are armed with useful tax knowledge and then partner with the right and skilled advisors. So that is me.
Great. It's great to have you, Felicia. Thank you so much for joining us. What a wealth of experience. And yes, starting from the beginning in all areas of advising in the acquisition is always more beneficial than trying to catch up as you move down the road. I'm trying to silence my notifications as we have everyone joining the community, and my notifications were set to announce that. And so I'll try to silence those in the background. I hope you can't hear them, and great to have you all joining in. So Felicia, let's start with a few questions. So it's common to hear that a seller wants a share sale for the capital gains deduction exemption. But from the buyer's perspective, what are the tax considerations of doing an asset sale versus a share sale or even a hybrid?
So I think before answering your questions, we need to first understand what type of sale there are. So generally there are three types. There is share sale, there's asset sale, which can be a business itself. So for example, AR will come along, employees will come along, or targeted assets. And then the third type is the hybrid sale. So generally in each scenario, the buyer will be the same, but the sellers will be different, right? For example, the seller of shares will be the shareholder who are selling the shares. And then the assets will be sold by the corporation owning it, right? And then the hybrid will be both the entity and the shareholders are selling it. So now, with that background in mind, we need to understand kind of what incentivize sellers. So to answer your question, yes, sellers generally like to have share sale because one of the biggest benefits is this lifetime capital gain exemption. So in 2024, the limit is about $1 million. So any gain realized on that sale can be reduced by $1 million. That's a significant tax savings. So in addition, it really it's also a clean separation for sellers because they don't have to worry about second layer of taxes when the corporation selling the share, selling the assets or business. And also, there's a lot of administrative burdens and cleanups and before the wind up and dissolving the company, right? Had they sold the assets through their corporation. So when they sell shares, that's not required. So they can just walk away with whatever the proceeds they have and they are done. So it really is a lot more, I would say, convenient for them. However, so the scenario that I just described is usually for individual sellers. When it comes to corporate sellers, however, provided that they are made whole or they are made equal, they may be indifferent as to what type of deal the buyer wants. So just keep that in mind. And then when it comes to buyers, what buyers will need to consider is, I think during your strategy setting phase, you should have already identified what it is that you want to buy, right? Are you buying for example, the core technology of a company? Are you acquiring personnel? Are you acquiring the entire company that comes with history and then, and reputation with the customers in the market and all that? So when the sellers decide to buy shares of the company, what they need to keep in mind, or you need to keep in mind, is really the inherent um, corporate liabilities, right? And then when you buy shares, you're paying for shares. That's your proceed. That's your tax basis. And so what that means is the corporate itself will inherit all the tax pools and attributes that come with it, right? All the regulatory compliance history, all the records, and even including some undesired assets that you may want to get rid of after. So, however, on the other hand, there are also opportunities for planning, and then also like identify whether or not there are tax programs or incentives that you can actually apply. For example, with respect to closing, there's a lot of planning that can be done. For example, during your strategy phase, you want to consider, okay, who will be the buyer? Are you going to be a buyer as an individual? Do you need to incorporate a new company as a acquire co? Or do you already have a company, but you need to set up another acquire co to acquire it? It really differs depending on your personal and corporate profile as well as your objective. But generally speaking, we encourage that, regardless, to have an acquire code that acquires share of the company being purchased. The reason being is that there's a lot of planning strategies that can be implemented by setting up a structure that is flexible and scalable, right? Not only right now, but down the road, so that you don't have to incur additional costs to set it up. If you set it up properly at the very get-go, then really it helps you, it sets you up for success. So for example, for pre-closing, there's, the structure that can be done, and then also, whether or not if there's certain assets that you would like to have increase in basis. So when we actually remember, like a couple minutes ago, I mentioned that when you purchase shares, you are actually inherit the tax pools that already came with. What that means is it's not at fair market value of those assets, because those assets previously already been depreciated, right, or carry at cost. But there is some planning that we can do to actually increase the basis while the seller still own it. Okay, so there's that planning we can do. And also post closing. So post closing, what we can do is when we have that new acquire code, we can actually amalgamate the the company being acquired and your acquire code. We can combine them, amalgamate them, so we can do this 88(1) bump of of eligible asset. Again, that is helping you increase the basis of the assets, for example, which will be very beneficial if you want to sell the asset separately, or you want to somehow maybe move that asset out. Then the tax implications on that, or the tax consequences of that, will be reduced because you bump up your basis. Okay. And when it comes to asset purchase, So again, as I mentioned earlier, you can decide to purchase the business, but not the corporation itself. So that will be considered asset purchase. What that means is if you have a purchase price in mind, you will need to have an independent valuator to allocate. So it's purchase price allocation to allocate purchase price to each item that you're purchasing. Okay. So what that means is now you will need to understand, the incentivize what incentivizes a seller versus what you want. So in an asset purchase, on the presumption that you are going to purchase the entire business, what that means is you will want to allocate the purchase price most to your non-depreciable property, meaning, for example, land. Okay. The reason is that when you sorry, uh, take a step back. From the seller's perspective, they will want to first allocate the purchase price, most of it, to non-depreciable asset land. Why? Because when the company record that sale, it will be a capital gain to them, which is 50% income inclusion rather than 100%, right? On the other hand, as a buyer, you will want to allocate the purchase price to first, like all the kind of income generating assets like inventory, like your depreciable property. Why? Because those bases, when you have high bases, when you sell it, that means your gain will be a lot less, correct? So if you have depreciable property, you have higher bases, it allows you for a higher future CCA deduction. That's better for you. So generally, that's the difference between the objectives of buyer versus seller. And so, you know, when you decide to purchase assets, the benefits will really be, for example, there will be no undisclosed or contingent liabilities that come with the corporation. And also, like, what you will need to be concerned with is all other kind of non-income taxes items like sales tax, property transfer tax, the other non-tax items, including conveyance requirements, regulatory and third party notices and consent and licensing. That in itself is a lot of work as well. So it really kind of depends on what your goals and objectives are. And then that should really drive your tax strategy rather than having the tax strategy drive your overall strategy. Okay.
Mhm.
And the third one is really the hybrid transaction. So the hybrid transaction has becoming increasingly more popular in the last few years because a lot of times, especially in the context of non-resident purchaser, they would have, for example, like internally developed intangible assets, right? So if the non-resident simply just purchase the shares of the Canadian company through a acquire co, Canadian acquire co, and then they want to leverage off that for their US customers as well, there will be a lot of intercompany charges. And then therefore they will want to bifurcate that asset and purchase that asset, but the remaining just purchase the shares of the company, right? It depends on what the objectives of the buyer are. So a lot of times also the Canadian buyers and sellers can't really come to agreement in valuation. They will be like, okay, perhaps we can step up some assets to allow the buyer to claim higher CCA in the future, and then thereby they are willing to compensate the buyer on the future incentives that they can get, right? So that's kind of the hybrid strategy. And generally, in terms of numbers, we have kind of compared, different scenarios. Obviously, for individual, I shouldn't say individual. Obviously, in a share purchase, I think for sellers, it's the best, right? Because there's a lot of incentives. There are a lot of kind of no worries, like a worry free scenario for them. Whereas when it comes to asset or hybrid sale, generally the sellers would want to insist on hybrid sale because the fact that the net result after tax when they account for both corporation and personal tax will be significantly lower than the asset scenario. Okay, so it's really better off for them. There's some tax strategies they can apply before selling the assets and the corporate shares to you as well. So that's why generally it's better off for them in terms of number wise. So I
Mhm.
mean, again, if you when you go into negotiation, understanding and knowing, appreciating what their objectives are and what take them, I think the negotiation will be a lot more successful.
Mhm. Mhm. Yes, boy, it can sure get complex. I'm assuming then at different levels or different sizes of deals, this complexity obviously scales with the size of the deal.
That is correct.
Interesting. With the smaller to mid size, I guess, do you generally see share sale or asset sale more frequently, or do you
I
have any
think
thoughts there?
I think we see a lot of share and hybrid sales. And then when I say hybrid, because if you think about like kind of, even 1 to 10 versus 10 to 50, the issues are quite similar. It really depends on the nature of the business, right? So
Mhm.
even though the business can be small, but if it involves in complex business like AI development and things like that, it sometimes will require a lot more expertise going into it, like even from the valuation perspective, even for tax purposes, like how can we structure a deal that really produce the optimal outcome for the
Mhm.
purchaser, right? And then obviously for the purchaser, the primary concern is really mitigating and managing risks.
Right. Yeah, fair enough. Can you speak to any or differing tax implications when purchasing tangible versus intangible assets and goodwill as part of that?
Yeah, that's a good segue question, I guess. So prior to 2017, there is regime called eligible capital property regime. So, a lot of intangible, especially externally purchased tangibles and goodwills and whatnot, actually gets classified into that particular asset class. So it's similar to what we call the, like depreciable capital property assets, but it's different because, upon purchase and upon disposition, the asset, the amount that goes into the pool for the 7% annual deduction needs to be prorated for a certain amount. And then when you dispose it, it's almost like a capital gain rate.
Hmm.
And then so before 2016, that was the regime in place. So ever since 2017 and on, right now externally purchased goodwills and intangibles go into this class called 14.1, subject to 5% of CCA annual deduction. And so right now it's really, it really doesn't matter a whole lot because again depends on whether or not you're purchasing the entire business, right? If you purchase the entire business, tangibles and goodwill will come with, and then in that scenario you will need to hire an independent valuator to allocate the purchase price because the CRA require any allocation must be reasonable, right?
Hmm.
So in those type of deals, CRA can easily, if you unfortunately you get picked for audit, your transaction gets picked for audit, CRA can come in and have their own independent valuator and then reallocate your purchase price.
Mm,
right? They have that discretion. And
okay.
versus, where you have independent valuator providing you with, the allocation and the report, generally they don't, get too fussy when there is an independent report already. So that's what yeah, the reason in terms of being reasonable, you need to keep that in mind. And then, so again, right now, with respect to externally purchased, that's how we deal with it. So, tangible versus tangible, really, it matters in the case of purchasing a business. But if you just simply purchase targeted business, for example, a customer list, right? That would just be treated as class 14.1 asset.
Hmm, all right. What about, let's get into due diligence. So ideally, we've done this tax planning in advance, and we know what we're coming in with, and then all of a sudden now we're faced with the seller and their perspective and their motivations. So when it comes down to we've got a deal in hand, and we're looking at due diligence as it relates to tax planning. Can you speak a little bit more to how it differs for the buyer and the seller, and what to be looking for, or red flags to be watching for from a tax perspective?
Okay, I think I'll break this down into two components. What is, first is really what is tax due diligence, right? And then how it differs between buyer and seller. And the third component is what, as a buyer, you should watch out for, kind of the warning signs. Okay,
Okay.
so really, what tax due diligence is really an independent investigation of tax affairs of a business, right? You're providing a tax profile of a company. So, which is generally undertaken before closing of a deal. So, what I've seen actually for bigger deals, they tend to have preliminary due diligence, tax due diligence that focus on kind of deal breaking issues, right? Then, like when we receive the signed letter of intent, or memorandum of arrangement, then you kind of go on to, do the actual tax due diligence process, or you start your tax due diligence process with all the items being specified that have kind of major impact to your decision, to your purchase decision. And so generally, it is used for buyers in a share deal. That's what I often see. And then I would say 90% of the time, I see that being used for share sale and then share purchase. And then with respect to the scope of it, so right now, other than the preliminary high level tax due diligence work, I will focus on my discussion on the specific procedures that we normally do during the kind of now investigation process. Now we signed a letter of intent already, and it's generally the process that we'll go through. So typically, the scope of our work is defined really to target key issues that have material impact to the deal. And then with respect to materiality, it really can depend on, for example, the deal size, right? What is the risk tolerance of the buyer? And then also, for example, like, the type of risk that the purchase is willing to bear. Like, risk can be monetary or can be reputational. And then in terms of the timeline, generally, the letter of intent actually provides you with a timeline as to when you need to finish all the work. Okay, there's a time limit. And then, so when we normally start the process is when we receive the letter of intent, we start with the, kind of discussion with the seller as to, okay, what's their objectives and what they consider key areas. So when they don't really have much of tax, not tax background information or tax knowledge, we will share with them as to what the key areas are, and then like propose accordingly, because we don't want to look at every single item. That will be too time and cost consuming. So we want to kind of really narrow down and then just, make sure that the issues that we are covering align with the objectives of the buyer. And so now we have understanding of what tax due diligence is. We want to talk about how it differs between buyer and seller. So we need to understand the motives of tax due diligence work. So for buyers, again, buyer generally focus on covering and managing their risks, right? Because the company, if you're buying shares, the company has the existing liabilities that you as a buyer will have to inherit. And so what we normally cover or investigate is really kind of significant transactions like historical reorganizations if they were undertaken, or like aggressive tax filing positions that they've taken on, and then transaction with related parties or non-residents, or even like they have ongoing CRA or anticipated CRA audits, right? For non-resident, for example, the reassessment period is actually being extended for 3 more years. That's why we want it to cover. And then also with respect to transactions with non-residents, there's just so much, with like tax issues and then tax filing issues. What I often see is that they are not compliant, like the sellers are not compliant. So this normally is a key area for us. And then with related party, we are worried about, for example, if they are transacting at fair market value, right? So it's really kind of whether or not their benefits conferred onto shareholders and things like that. So that's kind of the areas that we'll focus on. And then oftentimes when you're partnered when you partner with skilled tax advisors through this process, they will also identify some tax opportunities for you. For example, if there are some type of tax subsidies or incentive programs in place, they will recommend, when you should apply and when you should look into it. And then also, perhaps, for example, if the seller or the corporation has some tax attributes that you can utilize before the title gets transferred over or before you take control of the company, that they can be arranged, they should be considered. Because a lot of times, once you pass that proper timing, the right timing, then the opportunity is gone. You cannot do planning retroactively. It just doesn't work like that because it will not be accepted by the CRA. So that's kind of a few things that you can keep in mind. And really, the findings generally help the buyers make well informed decisions, eliminate surprises, and then perhaps the buyers can negotiate for a better price and deal terms, because they now know through findings what they need to be concerned with, right? So they can quantify them, they can bring to sellers attention if they did not do any seller due diligence work. Now it's the one, now you kind of become the party who maintain control during the process, right? For sellers, on the other hand, in the last few years, we have increasingly seen more and more of seller tax due diligence. I think because a lot of times when the sellers are not prepared and they just go to market, they find themselves like scramble and then really kind of, it's almost like being pushed over on all the terms and conditions because they are not aware of their company's conditions. They are not aware of their, company's tax affair because my accountant just does it all, right? Like, so they are kind of in that, it's almost like being forced position to really, sign the deal. So in the last couple of years, we find that as soon as the sellers decide to sell, they start asking their sell side advisors, right? Just like you guys, before you embark on that journey, you will probably engage, a company like Village Wealth as a buy side advisors, right? So they will contact sell side advisors to see what needs to be done to make sure that the house is in order, everything is all cleaned up, all the significant issues got addressed before going to market, right? So they will, for example, if the clients are ours already, they will contact us as to what needs to be done before selling, or the sell side advisor will contact us as to, kind of tax matters that needs to be addressed before selling. So anyway, in terms of the process, what the findings, sellers can actually strategically choose what issues to allocate time and resource to fix, to remedy, right? If not, then they can easily quantify the deficiencies in place. So, what that means is now they are more ready. And then, especially when they utilize reputable tax advisors, they can actually help streamline the buy side tax due diligence, because some buyers will simply rely on the independent report that, for example, BDO already
Hmm.
issued, right? That save a lot of cost and time and stress on both parties. As well, for buyers, by doing that, now they know what they are deal with, and they know what kind of issues that buyers may bring up through their work. They are now better positioned, better prepared, and they can maintain control during the negotiation process, and they know immediately, what to give up and what not to give up, right? So um, it really, again, is the objectives as to what the buyer wants and then what the seller wants. For example, for sellers, they want to get top dollar, right? By cleaning up everything, they are able to get, to get higher purchase price, and then also help them attract like better quality buyers.
Hmm. Yeah, if there are takeaways in the simplest of form, I think it's be prepared and have a tax advisor who knows and works with acquisitions regularly, because the complexities here are vast. I think what I'd like to do in the last, because we only have 15 minutes left, I'd love to turn to the audience and find out where their curiosities lie, and if we can answer some of those, and then we'll come back to maybe a bit of a summary on everything in general. And so I'll
Sorry,
turn it.
so one more
Yes.
minute to
Yeah.
address kind of a little bit of red flags. So when you kind of start dealing with vendors who are slow and non-responsive in addressing information requests, being vague in their responses, the evidence that we find contradict to their responses, or for example, like consistently being unreliable, unreasonable, and really just downplay the importance of the information being requested, that should be a warning sign
No kidding, right?
as whether or not you want to do the deal with the person.
Yes, yeah, fair enough. Um, all right. Who has a burning question they'd like to ask Felicia? This is a great opportunity. I know there are some. There are many of you on the call. Feel free to raise your hand. If not, I have more. Okay, Shiva, thank you. Please explain the buyer versus seller purchase price allocation for assets.
Okay, again, so it really depends on whether or not we're buying shares versus business. So, in the context of buying shares, allocation of purchase price has a lot more to do with accounting, meaning they have to they have to allocate based on the fair value of the assets acquired, right? So that is really for financial statement reporting purposes. It really has not much bearing on tax, because again, we automatically inherit the tax pools that come along with the tax filing positions, unless you want to change the year end, unless you want to, change the for example, for example, in terms of when the buyer acquire control of the company, that's when you purchase a share, you sign the agreement. Now the company is yours. We have to worry a lot about, for example, now the new filing period, right? When is the due date? And then the installment schedule, if that has changed. How does the payroll remittance works, right? Whether or not it still keeps the same schedule. So it's kind of those side things for tax purposes we'll have to worry about.
Mhm.
However, on the other hand, when we purchase a business, that it itself will have tax implications. For accounting, I'm not going to address accounting because I'm not a financial statement expert. For tax purposes, the CRA's only requirement is that the allocation must be reasonable, right? So how do you determine reasonableness of each purchase acquired? You don't. You and I don't. We don't know unless we go and then find out the comparative assets that we can use. However, that's a lot of work in of itself. So generally, we see that the client will engage an independent valuator to allocate the assets accordingly. So if they are depreciable, we put them into CCA classes for future CCA deduction. If they are just a normal working capital, then there will be no kind of gain or anything on that to be reported. You simply just plug into your balance sheet. That's it. And for non-depreciable item, we will get the fair market value as our tax base.
Okay.
Hope that answered your question.
Yeah, hopefully, thank you. Shiva says, and I'm getting a few messages now. So, um, importance of tax due diligence and acquisition process. I think we spoke to that quite a bit, but do you have anything you want to add, Felicia, to the
I,
importance?
I I think during the due diligence process, though, you will need to be thinking about how the terms in the purchase sale agreement impact you. Okay. So, a lot of times, especially, so given the current economic and geopolitical uncertainties, as well as a slew of new tax rules introduced in 2023. They have significant impact to our investors. Given those conditions, what we really need to think about the terms in the agreement, what the actual tax implications of on those conditions. The reason being is that because of those factors that I just mentioned, the contract itself, the agreement itself, has become more like increasingly more complex. And then that in itself introduce additional layer of complication for tax. And then that's why if you are, if when you are kind of reviewing the contract, it's best to have both commercial lawyer and accountants reviewing the terms and agreement, making sure that you know what you are dealing with. For example, if there's a significant fair value bridge or a gap to bridge, so you have your expectation of fair market value, and then seller has very different expectation of fair market value, and you can't bridge it. A lot of times, clauses like earnout or reverse earnout will be used for tax purposes. So no, not for tax purposes, to bridge the gap.
Right.
How earnout and reverse earnout are treated, there are 3 or 4 different treatments. So we need to kind of narrow that down.
Actually, I did receive another question, Felicia, around the tax implications for a share sale with a forgivable seller's note versus an earnout.
Okay. The topic itself is quite complex. I can spend probably a couple hours just on earnout, reverse earnout, and debt forgiveness. So generally speaking, for buyers, though, I'm focusing on buyers only.
Hmm.
So for buyers, the reverse, so let's talk about earnout first. Earnout is really when you are a buyer, you set the condition because you don't really believe the value that the seller, right, is asking. So you say, okay, I'm going to create this condition as earnout. So for the next 3 to 5 years, you're going to meet the company must meet certain conditions. For example, the EBITDA or earnings or something, right? So what that means is for you, the earnout condition itself was simply really the purchase price will increase for the seller as they meet the condition, right? So what that means is really that will be part of your tax cost for the purchase of the
Mhm.
share. Okay. Then reverse earnout is reversed, meaning you as a buyer pay them upfront, and then as they're not meeting the conditions, either they have to repay what you paid them or the purchase price will reduce. And then you will pay them exact the amount when they are not meeting it. Right? So a lot of times, generally for buyers, there should be no debt forgiveness issue with respect to earnout or reverse earnout. However, whether or not your cost basis should represent the actual purchase price itself or the reduced amount, that can be ambiguous.
Mhm. Hmm. Um, yeah, explaining an earnout from a tax perspective was something I had never thought of, though. I simply don't think of taxes as much as you probably do.
No,
But it's
no.
interesting. Yeah, very interesting. Well, maybe we'll probably have time maybe for one more, maybe two. So I'll head back up to Shane's. Hi, Shane. Head back up to your question around. He's asking Felicia, can you speak to financial due diligence on SMBs with poor suspect financial records?
Yeah, first of all, that will be a warning sign to you as well. So in terms of financial due diligence, it's quite different from tax due diligence. Financial due diligence is really kind of, help you hone in on like for example, financial due diligence, they normally focus on three areas. Quality of earnings, right? That is key if you're buying anything. So you want to, obtain some level of assurance on that. They also not audit, like they will review the working capitals. Why? Because generally purchase and sell contract or agreement has this working capital peg. If it's over, then if it's over, then you get paid, or not you get paid, like really your purchase price should have been higher, but you didn't take that into account. And if
Mm,
you're under, that means really like the purchaser is out for them, right? If the working capital is under. So you want some level of assurance on that working capital peg. And then the third thing is net debt, right? Like what liabilities you as a buyer want to assume, right? So if they are related party debt, obviously you will request the seller to clean it up before you buy the company, right? So that's the underlying nature of financial due diligence, which is very different from tax due diligence in that we focus on key transactions in the past or ongoing.
good distinction. Okay, I'm too busy listening and not following the chat, and I'm getting some direct. Okay, let's see here. Ali is asking me, what would be the best approach for buyers to uncover any existing liabilities?
I think what you would need to do though is really understand like what each liability is. For example, if you have a building, you are buying a building and land, you will need to review, you will have a specialist review the agreement and then the mortgage that come along with it. So that is a good quality liability, right? However, if there are other type of liabilities, again, with related party or personal debt or things like that, you will want to make sure that are excluded from the deal. And then somehow they will have to, a lot of times I think in the letter of intent already, they said that any kind of personal or related party debt we will not assume. And then that's a lot of times it's already kind of clarified and it's already been agreed upon. I think those type of situations, though, the agreement, the negotiation will already be, a lot of decisions will already occurred at the kind of preliminary discussion stage.
Mhm. Okay, wow. Well, we have so many other burning questions in the chat, so maybe we'll have to bring Felicia back another time. For now, maybe Felicia, if you could leave us with what is something you often see overlooked in this process, and then maybe just kind of a high level overview or key takeaways from your perspective.
I think there are a few takeaways that really are critical. A lot of times I have dealt with clients who didn't want to have any due diligence, tax due diligence done simply because they are friends. And then later on, they got to a point where, the earnouts is not met. And then like they got into big dispute and they took each other to court. That I've seen, you know, when you decided because of your personal trust that you do that. I urge you to not do that. When it comes to business, it is business. It does
Mhm.
not, should be put aside, and really you just deal with business as if you're dealing with an independent person. Okay? So that also come with, when you're not partnering with the right advisors, right? You think you can do it all because you can just Google and then find the answers and then proceed with what you believe you know. However, a lot of stuff, the things that you read may not be the right thing or the right approach. So without that in-depth knowledge, for example, for the as the buy side advisors, they are they have years and years and years of experience seeing all different type of deals. They can bring that wealth of knowledge and then just pinpoint issues and things that you can focus your energy on, rather than you like spending hours and hours researching things that you may not know how to deal with. So
Mhm.
definitely partner with the right advisors. And then lastly is really have the right person help you understand what you are dealing with throughout the process. Just remember that from the beginning, when you start to set your overall strategies, to the day the deal closes, there is whole slew of tax implications that you need to consider. It's not just a one-time thing. Let me sign the agreement and I'll deal with taxes later on. By doing that, you may have missed like critical timing for benefiting from some possible tax strategies that you can implement. So
Right.
definitely one, knowing knowing when you're not good at something and then hire the right people. And then second is, know the